The advance block pattern is a critical indicator within technical analysis that signals a potential bearish reversal. This pattern is identified by a sequence of candlesticks during an uptrend, showing smaller upward movements and increased hesitation among buyers. The significance of this pattern lies in its ability to alert traders to weakening bullish momentum, suggesting that a reversal to bearish trends might be impending. We encourage investors to practice identifying the advance block pattern in their trading activities. Developing the skill to spot such patterns can enhance the ability to make informed trading decisions. It's important to note that while recognizing these patterns can be valuable, continuous learning and experience are vital in mastering technical analysis. Concluding, it's essential to acknowledge the complexity of market analysis. The advance block pattern, while powerful, is just one of many tools available to traders. For more informed trading decisions, incorporating multiple analytical tools and considering various market factors is recommended. This comprehensive approach can provide a broader perspective on the market, enabling traders to navigate it more effectively and confidently. Candlestick patterns play an essential role in financial markets by offering valuable insights into market movements and trader sentiment. These patterns are represented through the graphical depiction of daily price movements in a format that resembles a candlestick, hence the name. They allow traders to visually comprehend market dynamics over specific periods, making it easier to predict potential future movements based on historical data. One intriguing pattern that often goes overlooked but signals a potential bullish reversal is known as the stick sandwich. This pattern consists of 3 candlesticks where the middle candlestick has a different color compared to the candles on either side of it, effectively sandwiching it. Typically, the scenario unfolds in a downtrend with the first and third candlesticks being green, suggesting upward movement, while the middle candlestick is red, indicating a day of losses within the sequence. The contrast in this arrangement hints at a reversal from a downward trend to an upward trajectory. The stick sandwich pattern is significant for spotting potential market upturns because it reflects a momentary interruption in bearish sentiment by bullish pressure, which is promptly followed by a return to bullish sentiment strong enough to close the session at a level comparable to 2 sessions prior. This pattern highlights the resilience of buyers in the face of selling pressure, suggesting a shift in market control from bears to bulls. Understanding and recognizing the stick sandwich can aid traders in making more informed decisions by alerting them to early signs of potential market reversals. The stick sandwich candlestick pattern is a fascinating setup in chart analysis, providing insights into market dynamics and potential reversal points. Comprising 3 individual candlesticks, the structure and arrangement of this pattern tell a story about the ongoing battle between buyers and sellers in the market. To visualize the stick sandwich, imagine 3 candles lined up next to each other. The first and third candles are similar in appearance, both exhibiting a downward trend, typically characterized by their open and close prices being close to the top and bottom of the candle, respectively. This reflects a period where sellers dominate, pushing prices lower. These 2 candles essentially act as the bread in our sandwich. Nestled between these 2 is the second candle, which contrasts sharply with its neighbors. It represents a day where buyers have taken control, driving prices up such that the candles open and close are near its bottom and top, respectively. This sudden shift in momentum is akin to the filling in a sandwich, markedly different from the surrounding material but integral to the pattern's interpretation. In essence, the stick sandwich pattern signals a potential bullish reversal. Following a downtrend indicated by the first candle, the appearance of the second candle suggests a resurgence of buying interest. If this buying pressure continues beyond the pattern, it can lead to a reversal of the downtrend, as hinted at by the mirroring effect of the third candle, which, while bearish, fails to push lower than the second. This pattern is a sign that the grip of bears on the market might be weakening, with bulls preparing to take over. Traders often look for additional confirmations beyond the stick sandwich itself, such as an increase in trading volume on the second candle or other technical indicators aligning favorably, before making a buying decision. Visualizing the stick sandwich without actual charts can be challenging, but imagine a central green candle representing a day of gains sandwiched by two red candles, indicating days of loss. The green candle stands out not just for its contrasting color, but because its bottom and top are noticeably distant from those of its neighbors, suggesting a significant tug of war between buyers and sellers, with buyers momentarily prevailing. Understanding this pattern helps traders recognize moments when the market's sentiment might be shifting from bearish to bullish, offering a strategic point to consider entering a trade with the expectation of a potential uptrend on the horizon. The stick sandwich is a technical analysis pattern that signals a potential bullish reversal in the market. This pattern is characterized by three main candles. To start, the arrangement of the candles is vital. There are two red candles with a green candle sandwiched between them. The first and the third candles, which are red, represent days when the market closed lower than it opened, indicating bearish sentiment. The green candle in the middle shows a day when the market closed higher than it opened, suggesting a shift toward bullish sentiment. An essential characteristic of the stick sandwich is the similarity in the closing levels of the first and third candles. This resemblance is crucial as it indicates a significant level of support from which the market is attempting to rebound. The color of the candles is fundamental, with the red candles depicting selling pressure and the green candle indicating buying interest or a pause in selling. For the stick sandwich to be considered a valid indicator of a potential market reversal, it should occur at the end of a downtrend. This positioning is critical because it suggests that the bearish trend is losing momentum and the market is setting up for a reversal. The presence of this pattern amidst a downtrend serves as a cue for analysts and traders that the sellers are getting exhausted and a change in direction might be imminent. In examining real chart examples, one would notice instances of the stick sandwich pattern appearing in various market conditions. The pattern is visually identifiable and typically followed by an increase in trading volume, which serves as a confirmatory signal of the potential reversal. While the pattern does not guarantee a reversal, it provides a strong indication when combined with other technical analysis tools. The occurrence of the stick sandwich at the conclusion of a downtrend is not just a random placement, but a signal of potential change. Investors and traders often look for this pattern to make informed decisions, combining it with other indicators to confirm the strength of the reversal signal. Its occurrence is a sign that despite ongoing selling pressure, buyers are starting to gain ground, possibly leading to a turnaround in market sentiment. The stick sandwich pattern in technical analysis is a fascinating indicator that suggests a shift in market sentiment from bearish to bullish. This pattern is formed by three candlesticks. The middle candle displays a lower close compared to its neighbors, which are typically green or upward. It resembles a sandwich, with the red or down candle in the middle being the filling. When traders encounter the stick sandwich pattern, it often triggers a psychological response. Initially, the market is in a downtrend, as indicated by the bearish middle candle. However, the presence of two bullish candles on either side signals a potential reversal. This pattern suggests that despite the selling pressure, buyers are gaining strength and are capable of pushing the price back up not once but twice. Such a formation can instill confidence in the bulls, encouraging them to initiate new positions or add to existing ones. Moreover, the stick sandwich pattern implies an exhaustion of the bearish momentum. The failure of bears to maintain lower prices, as evidenced by the pattern's formation, can erode the confidence of sellers. This loss in bearish momentum, coupled with a gain in buying interest, may lead to a change in the market direction. In essence, the psychological impact of the stick sandwich pattern on traders is significant. It serves as a visual cue that market dynamics are potentially shifting. Investors and traders who can accurately identify and interpret this pattern may see it as an opportunity to capitalize on the early stages of a trend reversal. Consequently, this pattern can lead to a tangible change in market direction as more participants adjust their strategies in response to the shifting sentiment. The stick sandwich is recognized as a bullish reversal pattern in the study of chart patterns, playing a crucial role in technical analysis. Distinctively, it is composed of 3 candlesticks where the initial and final candles are bearish, and the middle candle is bullish, visually sandwiched between the other 2. This setup is indicative of a changing momentum, suggesting a potential upside reversal after a downtrend. However, there's a common misconception that it might serve as a continuation pattern, which generally is not the case. For clarity, it's beneficial to describe how this pattern reliably signals a bullish reversal with the help of chart examples. Imagine observing a downtrend on a chart where the stick sandwich pattern emerges. The first candle is a drop, continuing the prevailing downtrend. Then, a rise occurs in the second candle, contradicting the trend but not decisively changing the direction alone. Finally, another drop follows in the third candle, but it closes approximately at the same level as the first candle's close. This sequence hints at the selling pressure starting to wane and buying pressure beginning to build, suggesting a potential upward movement. The importance of context cannot be overstressed for the correct interpretation of the stick sandwich pattern. One should consider the overall trend, trading volume, and subsequent candlesticks following the pattern for confirmation. Increased trading volume during and after the pattern formation, along with a bullish candle following the third candle of the pattern, would strengthen the reversal signal. In summary, while the stick sandwich is predominantly a bullish reversal pattern, signifying a potential shift from a downtrend to an uptrend, recognizing it involves careful consideration of the surrounding market conditions. Misinterpreting it as a continuation pattern can lead to misguided trading decisions. Observing the pattern amidst supporting indicators and in conjunction with a comprehensive analysis of the market enhances its reliability as a signal for bullish reversals. To understand the stick sandwich pattern's predictive power in the context of bullish reversals, it's essential to consider additional indicators such as increased volume on the closing candle, the strength of the preceding trend, and subsequent price action. These elements can greatly inform the credibility of the reversal signal or alternatively suggest a need for caution. Increased volume on the closing candle can serve as a confirmation signal for the stick sandwich pattern. A significant uptick in volume indicates strong buying interest and may validate the pattern's predictive value for a bullish reversal. This increased volume demonstrates that buyers are coming into the market with force, potentially overpowering the sellers and confirming the trend reversal indicated by the stick sandwich. The strength of the preceding trend is another critical factor to consider. For the bullish reversal signal of a stick sandwich pattern to carry weight, it should ideally emerge following a pronounced downtrend. A strong preceding downtrend suggests that the market may be oversold and poised for a reversal. The appearance of the stick sandwich pattern in this context can further bolster its credibility as a signal for a bullish reversal. Subsequent price action following the stick sandwich pattern is essential in confirming its predictive power. Positive price movements after the pattern's formation, especially if they breach key resistance levels, can reinforce the pattern's signal for a bullish trend reversal. Conversely, if the price fails to move upward or instead continues to decline, it may suggest that the pattern was a false signal, urging traders to exercise caution. In sum, while the stick sandwich pattern can indicate a potential bullish reversal, its predictive reliability is significantly enhanced when considered alongside increased volume on the closing candle, the strength of the preceding downtrend, and supportive subsequent price action. These elements can either reinforce the signal's validity or signal the need for cautious interpretation, making them crucial for traders leveraging the stick sandwich pattern for their investment decisions. The stick sandwich pattern is a candlestick formation that is considered to signal a bullish reversal, indicating a potential shift from a downward trend to an upward trend in the market. It consists of 3 candles. A bearish candle followed by a bullish candle that gaps down at the open but closes near the first candle's open, and a third bearish candle that closes at or near the same level as the first candle's close. The visual resemblance to a sandwich is where this pattern gets its name. In terms of historical reliability, the stick sandwich pattern has shown some success in forecasting bullish reversals. However, like all technical analysis patterns, it is not without its limitations. One of the critical aspects to understand is that the confirmation of the pattern is crucial. The appearance of the stick sandwich pattern alone does not guarantee a market turnaround. Traders often wait for additional confirmation, such as an increase in trading volume or other bullish signals following the pattern, to validate the reversal signal. Moreover, the context within which the stick sandwich pattern forms is significant. Its predictive power can be influenced by the prevailing market conditions and the pattern's location within the overall market trend. For instance, when it appears after a prolonged downtrend, the pattern might carry more weight in signaling a meaningful reversal. Given these considerations, it is essential for traders to combine the stick sandwich pattern with other forms of analysis. This might include trend analysis, technical indicators like moving averages or relative strength index (RSI), and fundamental analysis to gain a more comprehensive view of the market. This multifaceted approach can help traders make more confident and informed trading decisions, improving their chances of capitalizing on potential bullish reversals signaled by the stick sandwich pattern. In conclusion, while the stick sandwich pattern can be a useful tool in identifying potential bullish reversals, its effectiveness is enhanced when used alongside other analytical methods. Traders should always consider the broader market context and seek additional confirmation before acting on signals provided by this or any technical analysis pattern. To enhance a trading strategy using the stick sandwich pattern, a bullish reversal indicator, traders often integrate it with technical analysis tools such as the Relative Strength Index, RSI, Moving Average Convergence Divergence, MACD, and Fibonacci retracements. These combinations help to validate reversal signals and refine entry and exit points, thereby reducing risk and increasing the potential for profit. Firstly, the RSI is a momentum oscillator that measures the speed and change of price movements. When integrating it with the stick sandwich pattern, traders look for the RSI to be in an oversold territory below 30 and then start to move upwards, indicating a potential reversal of the downtrend. This alignment strengthens the bullish reversal signal given by the stick sandwich pattern. Secondly, the MACD, which displays the relationship between two moving averages of a security's price, is useful for confirming the momentum shift. A bullish crossover in the MACD, where the MACD line crosses above the signal line, combined with a stick sandwich pattern, can suggest a strong buy signal. Lastly, Fibonacci retracements, which identify key levels of support and resistance, can pinpoint potential reversal points in the market. When a stick sandwich pattern forms near a significant Fibonacci level, such as the 61.8% retracement, it suggests a higher probability of a bullish reversal. Real-world examples include instances where traders identified a stick sandwich pattern after a prolonged downtrend, with the RSI in the oversold region. Subsequent upward movement in the RSI supported the bullish reversal indicated by the stick sandwich. Confirmation was further solidified by a bullish MACD crossover shortly after the pattern formation. Additionally, if the pattern appeared near key Fibonacci support levels, it provided another layer of confirmation for the trade. By waiting for these conditions to align, traders were able to enter the market with a higher degree of confidence and successfully capture gains as the trend reversed upward. These methods, while not foolproof, demonstrate how combining the stick sandwich pattern with other technical analysis tools can lead to more informed and potentially profitable trading decisions. In discussing the stick sandwich pattern, a type of bullish reversal pattern in technical analysis, it is important to recognize common errors and misconceptions traders might have. One frequent mistake involves the misinterpretation of the pattern's significance without considering the broader market context. The stick sandwich appears as a specific sequence of candlesticks, but its predictive reliability increases when it forms within a downtrend, suggesting a potential reversal to an uptrend. Another misunderstanding comes from traders acting on the stick sandwich pattern without waiting for subsequent confirmation. It is a three-candle pattern where the middle candle is oppositely colored and has a price gap from the surrounding candles. The effective use of this pattern requires observing the market for additional confirming signals following the appearance of the stick sandwich, such as a positive follow-through in price or increased trading volume. Risk management also plays a pivotal role in employing this pattern. Traders sometimes overlook setting proper risk limits and exit strategies, leading to disproportionate losses if the expected bullish reversal fails to materialize. Implementing stop-loss orders and considering the risk-to-reward ratio helps in mitigating potential losses. In summary, recognizing the stick sandwich pattern as a bullish reversal signal requires attention to context, confirmation, and cautious risk management. By avoiding these common pitfalls, traders can better leverage this pattern to make informed decisions in their trading strategies. Leveraging the stick sandwich pattern in trading involves recognizing a specific formation on the candlestick chart that signals a potential bullish reversal. This pattern comprises 3 candles, where the first and third are bearish and the middle one is bullish. The 2 bearish candles have approximately the same closing levels, sandwiching the bullish one. Here is how traders can use this pattern for setting entry and exit points, including stop-loss placements and target objectives. Actionable strategies. 1. Identification. The first step is to identify the stick sandwich pattern in a downtrend. Ensure the middle candle is bullish with a higher close than the open, while the first and third candles are bearish and have similar closing prices. 2. Entry point. Once the pattern is confirmed with the third candle closing, consider this as a signal for a potential entry point. Some traders wait for an additional confirmation, such as a bullish candle following the pattern, to enter the trade. 3. Stop-loss placement. A prudent stop-loss placement is slightly below the lowest point of the 3 candles in the stick sandwich pattern. This guards against the risk of a false reversal signal. 4. Target objectives. Target objectives can be set by measuring the distance between the lowest low of the pattern and the highest high. This distance can be projected upwards from the breakout point to set a profit target. 5. Monitoring and exit. Keep a close watch on price action following entry. If the price consistently moves towards the target, consider trailing the stop loss to protect profits. Exit the trade once the price hits the target or if the market shows signs of a reversal back to the downtrend. Case studies. Several traders have used the stick sandwich pattern to capture market reversals. In one notable instance, a trader identified a stick sandwich pattern at the bottom of a significant downtrend in a tech stock. Recognizing the pattern, they entered a long position on the next candle's open and placed a stop loss just below the lowest point of the pattern. The market rebounded shortly after, allowing the trader to hit a predefined target at 2 times the risk taken. This trade illustrates the effectiveness of the pattern in signaling trend reversals and highlights the importance of disciplined stop-loss and target objectives management. By meticulously following these strategies and adapting to the market context, traders can harness the predictive power of the stick sandwich pattern to make informed trading decisions. The stick sandwich pattern in technical analysis is a bullish reversal pattern, indicating a potential shift in investor sentiment from bearish to bullish. It consists of 3 candles. The first candle is bearish, followed by a smaller bullish or bearish candle that gaps down, and the third candle is a larger bullish candle that closes at approximately the same price as the first candle, encapsulating the second candle like a sandwich. Understanding variations of the stick sandwich pattern can help traders identify different market conditions and potential trading opportunities. Let us explore some known variations and how they differ from the classical stick sandwich pattern. 1. The bearish stick sandwich. This pattern is the inverse of the bullish stick sandwich. It starts with a bullish candle, followed by a smaller bullish or bearish candle that gaps up, and ends with a larger bearish candle that closes at roughly the same level as the first candle. This pattern signifies a possible bearish reversal, suggesting that the uptrend might be losing steam and a downtrend could be imminent. Unlike the bullish stick sandwich, which indicates buying pressure, the bearish version signals increasing selling pressure. 2. The 3 inside up and down patterns. These patterns are similar to the stick sandwich, but differ mostly in their second candle. The 3 inside up pattern consists of a bearish candle, followed by a bullish candle that closes within the body of the first candle, and is finalized by another bullish candle that closes above the first. This formation signals a bullish reversal. Conversely, the 3 inside down pattern starts with a bullish candle, followed by a bearish candle closing within the body of the first candle, and a final bearish candle closing below the first, indicating a bearish reversal. These patterns emphasize the strength of the reversal by requiring the final candle to move beyond the first candle's close, whereas the stick sand, which focuses on the symmetry of the first and third candles' closes. 3. The tweezer bottoms and tops. The tweezer bottoms and tops patterns share a similar concept with the stick sand, which, by looking for reversal signals at the end of trends. However, tweezers focus on the wicks of candles rather than the bodies. Tweezer bottoms consist of 2 or more consecutive candles with very similar lows that occur at the end of a downtrend, signaling a bullish reversal. Tweezer tops, occurring at the end of an uptrend, consist of 2 or more consecutive candles with nearly identical highs, indicating a bearish reversal. Unlike the stick sandwich, which captures a price encapsulation visually resembling a sandwich, tweezers emphasize the precision of reversal points highlighted by matching highs or lows. When traders encounter these patterns, they can interpret them as potential signs of market reversal, but it is critical to consider other indicators and the broader market context to validate these signals. For instance, observing the volume during the pattern formation or applying moving averages can provide additional confirmation. Each variation of the stick sandwich pattern, along with its unique traits, enriches a trader's analysis by offering different perspectives on market sentiment and potential shifts in trend direction.